Welcome investors to one more episode of monthly interaction with Canara Robeco Equities team. What an eventful week this has been. There are events around earnings, there are events around geopolitics, uh, there are events both global and domestic. Let us go through them, some of them, over next 10-15 minutes. Let us start with the global aspects first. Uh, with the change in administration in US, of course, there was expectation that there will be certain policy changes around tariff and its implications for growth impulse globally. But it seems like it is getting far more complex than what initially was thought. Let us take them one by one. First is the economic policies of the new administration in US and how they are likely to kind of have repercussions for the both US growth as well as global growth. So when you look at the incremental US policies, tariff noise has been largely or actions have been largely along the expected lines. Of course, it is likely to have disruptions in terms of the supply chains which were developed over a period of time. One. Second, it is likely to actually put further upward pressure on the US inflation because ultimately US consumer is the one who has to pay. Third, which also means that effectively you can have negative growth impulse of growth because of tariff policies on US itself apart from the world in general. So that's the implications of the tariff policies. Now coming to the second part, which is basically how the DOGE is working, which is Department of Government Expenditures in US. And personally, I am most worried about this part because effectively what kept the world going over last 3 years in terms of growth and why the growth, one of the most important factor why the growth sustained was also that US was expanding fiscally and US continued to actually not focus so much on actually fiscal contraction. With DOGE coming in, there is a lot of expectations that effectively you will have basically the fiscal contraction happening in US to an extent of $1 to $2 trillion, which is very, very large. Let us hope that it doesn't happen in a very, very short span of time over next 1 or 2 years, because otherwise it will be growth basically negative for US first and then generally for the entire world. That's the second aspect. Third is effectively how geopolitics is shaping up. Clearly, it looks like the world is moving from unipolar world to multipolar world where US doesn't want to intervene in a lot of stuff. And as an outcome, what is happening is that there seems to be gradual non-alignment developing between US, Europe, Ukraine itself, whereby what you are seeing now is that as far as how to deal with Russia, there are two sets of different opinions that US has and Europe plus Ukraine has. Now, what does it mean is that if Europe continues to back Ukraine, it means the initial take that we had that probably the war will de-escalate faster can get kind of further postponed. So this is the kind of complex world where we are working. The key takeaway for us as an Indian investor and as an Indian economy from these things are three or fourfold. The policies around tariff clearly are more inflationary rather than deflationary, if at all, if they were to be implemented fully, which means there could be postponement in terms of interest rate cuts. Second, if DOGE succeeds, then there is going to be significant growth negative impulse locally in US and globally. However, while it will be very, very negative for US growth, it will turn out to be a good thing for globe because it means first the US debt will do well, and then invariably the US yields as they correct, people will look for basically higher yield globally, including emerging markets, and that has been one of the pain points for all emerging markets. That's second. That's also the reason why lately you have seen a little bit of basically yield drop in US from 4.7, 4.8 to 4.3 as we speak. That's second. Third, given the way world is where there is a non-alignment geopolitically and the economic policies are not very clear, you are likely to actually muddle through in terms of growth, and as an outcome the commodity prices will remain subdued, which is a positive thing for India. So those are the 2 or 3 things we're anticipating to continue to evolve. Having said that, one of the aspects that is on the minds of investors when the FIs will return, because from a global perspective, FIs have been a big seller over last 3 months roughly. They have sold roughly $15 billion of Indian equities, which is a very, very, or $20 billion of $15 to $20 billion of Indian equities, which is a very, very large number, almost unseen in the past or rarely seen in the past. When will it return? Our sense is it will only return when people will realize that the narrative that has been built over last 3-4 months, that US is likely to be more resilient and likely to grow faster than in the past, driven by tariff policies, driven by corporate tax cuts, driven by the reduction in the government expenditure cut through Dodge in US. Our take is likely to be more narrative than the truth. All these policies, they are only actually creating complexity, which will probably hamper growth in US itself. And as that happens, then the capital will change for basically emerging markets or higher yield outside US. Till that time, you will have a risk of, if we have to take a hunch, our sense is probably you are near there, and this hunch is based on the incremental data points that are coming out of US, whereby retail sales, credit card data, the data around unemployment, all of them have started turning fairly weak over last 2 to 3 weeks. So that's the global piece. Expect FII flows to at least turn neutral or next probably a quarter or so, and then turn positive at some point in time. Of course, within that, if we have to receive FII money, our earnings have to turn significantly better from where they are. So that's the global piece. Coming to the Indian economy, I think most of the macroeconomic indicators still remain healthy. As we have been saying for last several months, Indian economy is characterized by a very interesting phenomenon where the balance sheets are great, but the income statement is a problem, and income is a problem for a lot of effective households or population, because the public capex has not translated into huge private capex and broad-based real estate and consumption cycle, and we'll come to that. But before that, largely the macroeconomic indicators remain healthy, be it current account deficit, on fiscal path through budget we continue to move in the right direction. The core CPI inflation remains in the range where it is largely expected. The interest rate cut has happened. Expect one more interest rate cut over next 6 months as the US yields actually start normalizing or moderating. Tax collection still continues to grow at 8-9%. Government capex, which was struggling in the first half, has actually recovered. So most of the macro indicators continue to remain stable economy. Though probably if at all we have to highlight one thing, because of FI outflow and because of the global reason rather than local, the currency has been under stress. In our view, a large part of that stress also you have already witnessed. So you're probably towards the end of it rather than at the start of it. Having said that, the growth has been a challenge. Over last 3 quarters, the growth has tapered both in terms of GDP as well as basically in terms of the underlying corporate earnings growth. The corporate earnings growth for last 3 quarters have on a sustained basis being single digit, and that's a worry, and that worry in the context of the excess liquidity and FII outflows has led to what you are seeing in market right now. So let us come to this piece little later, but before that, in terms of the one of the worry that people have is that is capex is likely to significantly change from central state governments. Our view is yes, it is moderating. The government has clearly indicated it in budget, but it is just moderating from a level which was really high. So government capex, public capex was running at 20% CAGR over last 4 years. From there, government has actually redirected its taxes towards basically consumption through basically tax cuts in budget, your tax benefit to a large population through budget, as well as the state level, the freebies. It is just redirection. So capex has reduced from 20% CAGR to 10% CAGR, and consumption or revenue expenditure is being taken up from high single digit to closer to double digit. So that's the change that you are experiencing. It doesn't mean that the capex is not likely to happen, but it only means that little bit of resources has been taken from the capital expenditure side and are being provided to the households which have suffered in the economy. Just to look at it as 4 key stakeholders in the economy. The public capex has happened, private capex is happening, but is happening at a 10% CAGR, which is still low for earnings to grow at a faster pace or the economy itself to grow at a faster pace. The banks are doing credit, the credit had also suffered. Now it is, our sense is it will start moving back a little bit. but credit growth is still healthy or resilient at 11% growth YOY. The real estate cycle, at least in top 20 cities, continue to do well. It is the consumption and exports part of uh, e- the economy which were a bigger challenges, and that's where government has decided to, both state and central level, the governments have decided to address little bit of consumption at the cost of little bit of expenditure, and that's the change that you have seen in budget and through several actions across the various states. And that's where we also think that probably at the margin consumption is likely to come back gradually, first rural consumption and then probably urban poor consumption. Exports still likely to remain weak given the global complexities that we have already discussed. So that's the domestic macro. Nothing wrong, but growth is a challenge, or growth is moderating. Coming, and this is what is exactly reflecting in the corporate earnings growth. Corporate earnings growth for first 9 months has been in single digit. The third quarterly results are just have just been completed. The story has largely been the same, but within that, the story has been relatively more resilient for mid caps and large caps, who have, both of them have earnings growth which is high single digit, but the earnings growth for the small caps have been fairly bad. The upgrades to downgrade ratio in the small cap category has been fairly bad. But to just aggregate it, for first 9 months, single digit earnings growth, predominant reasons have been basically the government capex which was running behind the schedule, the consumption which continues to remain weak, the exports which remains very modest, and the private capex which is growing but actually not surprising on positive side, not growing at 15-20% but just growing at 10%. And the combination of these things have actually led to earnings downgrade. Our sense is earnings decline is more cyclical rather than structural. People generally tend to forget. We have seen the same kind of earnings growth in financial year 23 as well. So we had financial year 23 where the earnings growth for Nifty and generally for broader market was single digit. Then we had financial year 24 where the earnings growth was upwards of 25%, and now you have financial year 25 where the earnings growth is again likely to be probably high single digit as we close the year in March. As and there have been some contextual, some reasons, particularly the government capex as well as sizable monsoon for this, and then the negative growth impulse from global side. As we go into financial year 26 on a bottom up basis, when we look at the numbers and when consensus is looking at numbers, and as that happens, and by that time our sense is some of these global worries that are there today, particularly related to money flowing back to US, will also recede, and combination of these things will stabilize the market, as well as people will start looking at it more from a opportunity perspective rather than from a threat perspective. This is also reflecting in the valuations. The valuations for Nifty are already below or at its last 10-year averages of about 19 and a half times 1 year forward earnings. As far as mid cap, small caps are concerned, they are barely 10% premium to their own historical valuations now. Mid caps still are at little more to premium, probably 20% premium to their own historical valuations. Small caps have come back to probably 15%, 10 to 15% premium to their own historical valuations. Now the incremental catalyst that market needs clearly is valuation is already in place. The incremental catalyst that market needs is basically to see how the earnings actually start improving, and as market gets the evidence that earnings have bottomed and they are start to recover, driven by incremental focus of government on consumption, both private and government capex continue to grow at 10%. As export stabilizes, you will see that the earnings normalizing, which is what consensus is penciling in. And as that happens, along with basically the FI outflows kind of becoming neutral, which have been quite negative over last 3 months, our sense is market will bottom, and then we'll start looking at it more opportunistically rather than as a threat, as people are looking at it today. We have always been votary of the thought process that particularly people should look at equities as a long-term asset class. It is a non-homogeneous asset class. People get excited and people get disappointed. Typically, anybody who wants to do asset allocation should of course, consult with their advisors, but do the asset allocation when there is a blood on the street, when there is basically fear on the street, when there is a disappointment in terms of earnings, because that's when you get to buy good equity assets, good stocks, good mutual fund portfolios at a reasonable valuation. And today we are coming almost from a historical perspective in that zone in terms of valuations across the categories, and that's where we would suggest people to look at market now incrementally from next 18 to 24 months perspective, more opportunistically, rather than worrying about what has already happened over last 3-4 months, where people have seen 20% drawdown in their portfolios. So that's largely from our side. In terms of portfolios, as a corollary to how the government expenditure is changing a little bit from capex towards consumption, we are also basically changing some of our portfolios little more barbell. So some of the weight has been taken out from domestic cyclicals like auto, like industrials, like real estate, and that weight has gone into basically either domestic consumption or defensives, including sectors like FMCG, including sectors like consumer discretionary, including sectors like hotels, hospitals, aviation, pharma, telecom. These are the sectors where the weights have been increased over last 6 months. So put it in overweight, underweight perspective. Today the portfolios are neutral to overweight on industrials, consumer discretionary is overweight, telecom is overweight, pharma is overweight, hotels, hospitals, aviation is overweight. These are the spaces. Cement is overweight. These are the spaces which are overweight. The spaces which are predominantly underweight and large financials and large NBFCs is overweight. The underweight position is in commodities, global commodities, oil and gas, and to some extent FMCG and IT. So that's how the portfolio is positioned as barbell, whereby there are some domestic cyclicals which are overweight and rest are defensive as overweight. That's largely from our side for last month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.